What's up, guys? Welcome back to the channel for the official drop of the DTFX ZIL model. Now, I know you guys have plenty of questions, such as what is ZIL, and a host of other questions that were probably answered before in other videos, but you guys can be sure to comment below, and I'll try my best to answer a few questions, unless they're questions that probably shouldn't be asked. So the zone to impulse model is literal to its name. Zone to impulse is an order flow sequence that you see in every single price swing. Every chart will show it. Every asset class, you will see it on. All time frames, you will be able to see it. And the best place to trade them from are what? Zones. It's in its name. So the model is a 100% mechanical model. What does that mean? What do we mean by 100%? You know, because you guys love math, but don't want to use it when it comes to risk, right? 100%. It is required for you to follow it 100% based on the instructions that will be given in this video to achieve the best outcome. Now, I know that in the trading community, we love to learn certain things and add it into already existing things, and then we like to deviate and create our own way to do things. That stuff is great, but as you are learning, learn it the way you're supposed to learn it first, and then tweak it after. Don't just jump and tweak it before even finding profitability with it, because that's how you end up right back at square one, right? So the ZIL model was created to increase R. We usually have about, a minimum of 3R, but I'll let you guys see on the model itself, and it'll show the different kinds of R that the model gives within the same already existing DTFX concepts. It just reinforces why it's best for you to trade from your zone than anywhere else. And I'm glad that we finally put together a model to show you why it's important for you to prioritize trading from the zone, right? Trade your plan your trade, and trade it from a zone. So let's get into this. Now, before we begin, I would like to take this opportunity to shout out my sponsor, my Lord and Savior Jesus Christ, because if it wasn't for him and his teachings, I would not be here giving as much as I give. We're supposed to give to the less fortunate. We're supposed to give to those who cannot afford it. We're supposed to be the person to give a helping hand to those below us, to help them up to where we are as we go higher together. And he's the reason why I've come to the internet to give all of this free knowledge and free education to you all. His teachings were the things that touched me, and I hope it can impact you too in some way, shape, or form. So here's a look at our Fibonacci levels for our inner impulse and outer impulse. Here are my Fibonacci levels. They have always been the same: 0, 3, 5, 7, and 1. The only difference is that now we have 1.2 and 0.2. That's negative 0.2. So these numbers will be the same whether it's for the outer impulse or whether it's for the inner impulse. Both Fibonacci's will have text on each line. As we mentioned, these are the Fibonacci levels, but each level has its own text to it because you will be reading it as instructions for your entry. So we start off with our zone entry, right? That's always going to be the thing that we see first. Then we have our break even, right? And then we have our partial. If you take partials, then we have our full take profit. And then you could have a runner and so on and so forth. We'll explain how the entire thing works out. And likewise, on the other side too, it's essentially the same thing. This is whether you are bullish, whether you are bearish, whether you are in a range. It doesn't matter what price is doing. You're always going to use this for every single entry, calibrated to whatever time frame you are trading that zone from. Okay, so this is going to help to guide you. Now, since we know that every POI that we get into, every zone that we choose to get into and trade from has its own POI somewhere nearest to the low that might have put in that high, or the highest point that put in the low, right? They all have that invalidation to it, that should we want to take a trade higher, you can see that we can get in there with our stop behind the zone, as well as should we want to take a trade lower from this zone above, we know our invalidation will go right behind the zone there, right? So with this particular model, your invalidation is actually wherever it is that you take your entry, and this is why no zone, no trade is important, and it's going to prove that to many of you. Wherever it is that you take your entry, you have your own invalidation for that particular entry that has nothing to do with the POI itself, right? So you can essentially reduce your risk utilizing these rules that we have that you're going to see in a moment. You can reduce your risk to a invalidation that's to the model and not an invalidation that's to the POI. And that would allow you to maximize that reward that you can get. So let's get right to the charts and show you guys exactly what you need to see. Before we move forward, let's put it in reverse a bit. So what I've found is as we continue to generate highs and lows, right? We're expecting higher highs and higher lows, right? Let's take a couple more of them there and put them on the chart. Okay. So we have our highs and we have our lows that are here. And what we're looking for is price to now break this low, right? Take the low, tap back in, and then short, right? That's what we're waiting for. So when we see price tap back into our previous range below after sweeping a low and tapping into our POI, right? Or tapping into our low or tapping into our zone, all of those things are, other words that are taught, of concepts that are taught here on the channel, and you guys can go and watch those videos to catch up. So with this here, what we usually anticipate is what? When we're looking for price to trade back into that previous range. What is the previous range? Well, we have that low there, right? We have that low that's put in. We break below. We trade back up above. So this here, what we have in this gray, is that previous range, right? That's what we would traditionally use to take an entry off of to what? You guys know what's next? To short, right? If you said that, you got it right. So when this is trading back into this range, the only thing that ZIL changes for us is that when we get tapped in at the 50%, right here, the low, which is this low here, that brought us back up to our entry, right, for us to now take it and trade away, that low is what we call our target. So if that low is our target in the 50% or whichever level based on our back testing that we often see, we decide is the level we want to trade from, right? We click on the zone, right, the 50%, and we bring it to the low of the impulse. What is the low of the impulse? The low of the impulse is that move up that led to our entry. That entire move up is called the impulse, right? What we're looking for our entry to do is be the impulse back down to take us below maybe some consolidation that happened below here, right? And that's the crux of how we trade from that previous range. But what this fib does for us, let me just move over our original POI there. What this fib does for us is that when we get tapped into the 50% or the 30% based on whatever time frame we are trading from, and I'm going to show multiple time frames and multiple pairs, right? When we get tapped into that zone, we often see if our short is here and we're targeting the low that's down here, right? The low that led it there. And it could be any kind of low. It could be a huge push that ran into the range. And now we're looking for some turning point to now happen up here, right? And now we're targeting that low again, right? So we're taking up our entry within here. But traditionally, our stop loss used to be behind the zone, right? Or stop loss used to be behind some sort of candlestick structure element that happened within this area here, within this level here, right? So now what ZIL provides to us is it allows us to get in on the zone, right? And it allows us to target the low of the impulse that brought price to our zone, or that brought price to our entry. So if I can move in just a little more and show you guys here, the entry would be here, right? The invalidation would be behind this high right here, right behind this, the fib. So this is where you go break even. When price hits the 30%, right, of that impulse up, when price retraces back to the 30% of it, that's when you're going break even for this entry. And you have other levels there that you can target, where you see right here, there's the 30 that you can target. There's the 50, right? The 50%. There's the 70%. What is this the 70% of? Is it the 70% of the zone that we have to the left, the zone that was created after the break? No, it is 70% of the move that traded back into the zone. It's 70% of the way back down. If I want to fib this entry right here, I'm able to check zone, right? That's the click, right? I click there to impulse, right? The zone to the impulse. That's the low to the target, right? Zone to impulse. Now, these levels that are here are going to help me to manage my trade down until it's risk-free and it could continue to run. So all that we're changing within this dynamic is where we get in. We now have a way to manage that entry on the way down, right? A target for runners should we want to leave runners and not have to exit at what? The 1-to-1 of our zone, or the bottom of the range, or whatever it is. If we have some conviction that price is going further, we could allow runners to go further with it. But not only that, we have this inner impulse that's here, right? So the inner impulse is the low that's here and the high that's here, and we trade it back in, right? The outer impulse, what's actually happening here is you have this high up above, and then if I can take this high where the original break happened and draw the fib from the original break, right? This is the outer impulse fib now. The outer impulse fib is leading to the low of the trend, right? So what we have here is this is where the trend originally hit the higher time frame POI or something back there, right? Let's say it hit something back there, hit the higher time frame POI. And when it began to trade away, it broke structure to the downside now, right? And it entered you into your position here. But the higher time frame POI, if you're not a person who was able to execute and have that large stop loss, we wait for the lower time frame shift to occur. Then price trades back up and gives us a smaller stop loss to take part in the larger move, right? So what we're doing here is we would be taking part in this move down, and our runner would also be going to the outer portions of that previous impulse up. But what it would often be tapping into is a previous range that's down below here, right? So what it looks like is it consolidates, right? It trends, right? It consolidates, right? It pulls back, right? But that pullback could end up being a reversal should price want to go down all the way to the low. But if it does not, what we would do is we would use this outer impulse to be sort of the compass for us, that when price does indeed get back to this low, right, and run this low and take this previous low and take the zone there, when price indeed gets back there, our outer impulse, right, the larger zone, is telling us that we've reached about 50% of the impulse up, right? Or about 70% of the impulse up. And that's oftentimes when we get to some of the original POIs that we discuss in many of the videos that are taught here on this channel, the origin of the move, or sometimes you get to the S&D responsible. The market is just a ton of impulses in different directions, right, that make up either trends or ranges. So if we have the lower time frame trends that create the higher time frame structure, then we can trade each impulse within the context of both time frames and still be successful, whether it's for what? An inner impulse scalp, or whether it's for an outer impulse position trade, whatever it is. I'm going to show you guys that this works on every single time frame you can find. You just have to understand the move. And if you can understand how to trade within the cycles of the market, whether it's trading lower, whether it's trading higher, and using this particular thing to manage, it would greatly improve your trading. So here's the 15-minute time frame, and I'm going to take a POI from different pairs and different time frames and show you guys how the same things tend to happen, whether it's above or below the market, but it's within market structure. So as we see here, we traded up. If we count our swings, we see that we're already at the level where we can consider looking for a reversal to the downside. And what we have is this zone right here to the left, right? So if you see us tap right into the 50% of that zone there, 50% of the gray zone above, let me make this yellow below. If you see, we tapped right into the center of this zone. Let's take our fib levels out. Right there, right? We hit the 50%. That was the POI that price went straight to. Didn't even give the 30 any budge or anything. So the 50 is where price ran directly to. When we tapped into the level, if we go from zone, right, to impulse, right? So it's tapping on the zone entry right here. Let me make this a little larger for you guys to see. It's the zone entry here. You see the stop is right there. It's not even behind the zone anymore. It's just right behind the actual tap and that extension there. And we see that as we head down, price goes to what? The very first thing it taps into is the break even, right? Then the next thing we have moving down the line is the partial. And after the partial, we have the take profit, You see it ran right to the take profit directly after a tap into the entry, directly to take profit. We also have the outer impulse, right? Bam, right there. So as we mentioned in the previous sections, were that when we got to that break-even point of the larger move, right, we would be expecting price to run down to these targets, correct? And this would be the runner for the larger move up. And down here is the runner for that little internal move if you are a part of that. But that internal runner can end up running to the external runner. And this is, I think, by far the only strategy I know that has a runner for your runner. So what we have here is that we begin to move forward with this, and we see how price ran straight to the low, correct, of the internal impulse. But the external impulse, we look at where it hit, and this hit the 50% of the external impulse. So remember what we mentioned in regards to this, that the 50% of the external impulse can indeed send price back to that high, right? So we want to be cautious of this, but also understanding that we're looking to what? Now run to the upside to where? What did we say earlier in this video? To the previous range, right? So where is the previous range? The previous range is right here. Now we take that as the previous range, and we look for price to trade back into the previous range, and then make its way, what? Back to the downside. So if we wanted to find another entry within here with the same criteria to trade to the downside, we could. But while we're waiting for an opportunity on the downside here, right? Because it's down into the 70% of the range, and it's at the origin of the move, as we discussed earlier in this lecture. Here, when we get right here, we can find an opportunity here to move back up to where? This range high. We could look for price to give us an opportunity to run back that way, should it want to. Now, obviously, we would have to see our confirmations within here, but we know price goes from high, right, to low, back into where it originally traded out of, to high, to low, back into where it originally traded out of, right, to high. So if we understand the internal impulses and the external impulses that we would see down, and the bullish impulses that we would see up, if we understand where we are in those market cycles, then we know to buy low, right, and sell high, right? So we have to wait for the market to achieve these areas, or at least here, at least the 50 of the outer impulse, in order to begin to look for some upside. But we still want to see some confirmation in those areas, right? So I know you guys don't really like my drawings, so I'm going to keep them at a minimum, but they're definitely going to be there. We want to see price run back into this range, right? And then move back down, right? No matter how many highs and lows it makes, we're looking for it to get back to that previous range, or back to that 70% of what? 70% of the impulse up, right? This is the 15-minute time frame. So this is not tied to any time. This is not tied to any POI. This is just specifically tied to what the market is currently giving us now. So whenever the market does open up again, you guys will see this on all time frames. Let me just say that. You will see this on all time frames. There's no time frame that you won't see price move in this manner and respect it this way. And this is market structure. It's just trends, right? It's impulses that put in highs and impulses that put in lows, right? It's trends and ranges that turn the market. now we're looking for price to trade back into this range and then short to where we're expecting price to deliver, right? The full TP of the larger POI, right? That's what we're riding down. And that is the only time we begin to anticipate potentially if price can give us a move back up into the range. Why? Because that impulse down now becomes the target. What do I mean by that? Well, let me just move all of this forward actually. What I mean by that is that if you move this forward here, you see price move towards the POI and then run right into it. Bam. That's what we want to see. I might have went a little too far here, but let me just come back here. That's what we want to see. We want to see price come back into our POI. We want to see price fully deliver that original idea, right, of trading out of the top of this range, right, and shorting back to the bottom of it here. And this is the only time we begin to look for our longs, right? Because guess what? These people here that hoped the market would trade higher, they all have been taken out. In the words of Stoic TA, thanks for playing. So when we have that, the only thing we have left now is low risk longs that are within this POI here, right? With the invalidation of the POI here, right? But the invalidation of the idea is below the POI, right? But the invalidation of the entry is different. So if you were taking a trade within the S&D responsible here, because that's what price tapped into the left, if you saw here, if you were taking an entry from there, your entry would go from entry here to internal target up above there, right? So let me just move some of this and so your entry would go from entry here to your internal high, which is here. This is the high, right, that led it to that entry. I would more or less say it's this here too, but let's use this here because there was no body closure. Let me just double check. Yeah, there was no body closure on this low, so you want to take that as the master high, right? So we have our internal, right? Internal target there. And then the external target, where's the external target? The external target goes from the same entry, right? POI, to now the high, the highest point that led to that low. The model still has to be traded within market structure. So the very first thing you saw us note or you heard us mention was that we were in the position to now begin looking for shorts based on our trading plan that we developed in the mentorship. Now we know we can begin looking for shorts. So when we began looking for shorts, now here's our targets, here's our management, and now that we're in the bottom of the range, right? Now we're looking to take price back up into either the internal POI or even the POI that originally sent price down, right? Because it did take out some structural lows as it made its way back down there, so there could potentially be a strong POI, but we don't know. When we get back there, we'll see. So is it worth looking for longs within here? Yes, it absolutely is. And as you saw, we clicked forward a little too fast, but as you saw, the POI is here, right? And your entry is usually tied to your zone, right? So your invalidation is usually directly behind the zone you are trading from, right? But because some people have issues not really knowing how to choose specific zones, this is something that would keep you guys out of trouble, at least sometimes. So what we have here is we tap into this POI, and what's the first thing that we're doing? Break even is here, right? Partial is here at 100 points, right? Full take profit is here, and then you let the runner run until it reaches the runner for your runner. So this is what we're anticipating, right? Not necessarily all of this now, but let's just move it into there, because this is managing the initial tap of the entry, and whatever the entry gives us begins to help us to manage the larger idea of it if we see that price has given us those confirmations that it wants to move back up again. And we have those confirmations based on what we teach in the mentorship too. So this is why we would be comfortable with taking a long here. Now, the POI is the fib has its own invalidation, right? And sometimes the POI would be closer than the actual fib invalidation based on whatever the distance of the swing is that you're targeting, right? Or the high is that you're targeting. So when we click this forward, we see, price ferociously, moved back up into that direction coming out of this POI and out of the origin of the move. We understand that these two POIs are the most powerful moves in the market, and that is the reason why I teach them on this channel. So this would already be at break even, right? This entry. But if the full idea delivers, the full idea takes you to about 5R. The TP, the full TP for the entry takes you to about 3.5R. And this is how most of your entries are going to look. The same entry that we had to the top side had about the same amount of R to it. But if you saw when it ran, it actually ran a lot lower than we allowed the fib and entry to let it go. So it ran quite a bit. That was about 8R from a 15-minute POI. So we're looking for price to go back to this and the runner for your runner and all of that other stuff. Let's just click through and see what the outcome ends up being for this. You see you're at break even. You see price taps back into this and shoots higher, right? Trades up above. It delivers to there, right? So let's move to the next one. We have gold here, right? This is gold on the 1 minute. And what we see, and this is something that I was observing, prior to market close on Friday. But what we see is we see gold trending higher, right? We see gold put in this low, right, with this wick here, and we moved higher, back up into the range. So what we had was a flip. We had price test, trade higher, come back into the range here, come back into the range here, come back into the the smaller range there, and now we're looking for price to trade higher, come back into the range for a potential opportunity to move higher again, right? That's how we look to trade a trending market. We look to get involved with what the trend is doing, right? So let's take this POI here. This is just premeditated, believing that it's going to close up above and then trade back into the range. And that's the only time this POI ends up being good, is if you close up above it, then trade back into it. So we're just drawing it out premeditatedly. And we have this high taken. You see the body there, right? Let's put our fib levels in here because that's our zone now. Let's get our levels on the chart. Let's get our fib out. This would be an internal fib swing because this is one that's current and not something that's in past price. Outer impulses are usually in past price, and inner impulses are usually related to the current swing. So we have the entry. Should price begin turning around from up here, we would end up having the entry down here. We would look to take price back to that same high, right? The high that leads us to our entry. Okay? So let's play it forward. And guys, let me take a minute and show you guys this. If you caught a short from this zone to the left, right? Let's say there was something over here to the left side that you were catching a short out of somewhere within here. What this move down ends up being is an internal impulse move, right? So there's price tapping into that POI to the left that you might have charted out and was scouting for that short. That would be somebody on the short side, right? With price trading down now into your previous range. That's an entirely different position that would be managed versus the one we're looking to trade with the trend. So you can use this on either side of the market so long as you pair it with the zone. This is why we say no zone, no trade, right? So if price is here and you're looking for that 30% tap and you get it, then you could be in that and manage your way out with that entry, right? But should price drop into the 50%, hit that, it'll invalidate you, right? If you're trading from the 30 oftentimes, and then actually trade your way. So what's the best thing to do in this type of, predicament? The best thing to do would be to utilize candlestick structure when price gets into your POI on a lower time frame, right? Then you want to start seeing that shift and happen, and you want to be able to tailor your POI to something smaller within there. If you're not trusting of that 30 tap or that 50 tap, or you just don't know when price is going to tap the 30 versus the 50, so you have to let price come into your POI. So we see a bounce off of there, but we would be anticipating price to run this because this is the zone at the top of the range, and those often don't hold. So this is where most people are induced, right, to now go long. Most people want to go long out of here, and they believe price is ready to go higher because it tapped onto this POI here. And then we end up violating it, tapping in, and we have now an internal impulse and the external impulse, right, to trade back up. So here's what we do. We move it right over to here. That would be our entry right there, right? The stop usually would be behind the zone, but this is placing our stop directly behind the 70. It could get hit. It may not get hit, but this is how you manage. So when price gets to the BE point up above, that's where you BE, and this is how you would, manage the rest of the move. You could partial if you want, you don't have to. You could TP if you want, you don't have to. But what you need to do is know where to start, right? So you can consider the different ways to pay yourself. So you can consider different ways you could manage, the entry that you took. You need to know where to start. So you see this trades back up and it hits the 70% right here. Gives you the 3R from that entry, right? And you could even reduce it smaller to candlestick structure within there. But the runner's responsibility would be to go and get the high, right? Go and get wherever it came from. That's a runner's responsibility. It's not yours. If you were here and you were able to partial or full TP or whatever it is you took out here, right? Not full TP, but you're able to partial and then allow something to continue to run, your break even is down here. So should you see something like another entry potentially, taking place, you could even re-enter and move that average up, right? You already have a lower position to now be able to trade higher if the market is looking for higher prices. So you could always find a way to get involved if you know where your entry is, where your target is, and how you're going to manage. So I showed you the 15 minute, I showed you the 1 minute. Here's Euro USD on the daily time frame, right? Daily POI up above 30% of the previous range, right? So let's just take the 30% here and bring it to the external low, which is there, right? Or the outer low, whatever you want to call it. Larger time frame structure, the valid low, anything you want to call it, it doesn't matter. You know that that's your low and that's where it came from. So the next one you see is price moving whatever low that's moving to that entry. That one is the internal impulse, right? So that's going to lead you to the BE of the external move, right? The larger move, right? Or the outer impulse is going to lead you to the BE of that. Oftentimes, the delivery of the internal one is going to lead you to the BE of the outer impulse, right? So let's just click here, and there's the internal impulse right there, because we know that's the low that's currently bringing it up. It can change, but that's the low that's currently bringing it up. Let's click forward. The entry is there. You see that it's putting the target there, and it's putting the entry there, and the target is here near this low, or even right there. As I mentioned, this is oftentimes a 3.5 hour target, and then the low is there. So if you're targeting that, then that's fine too. But you want to begin to manage like this, right? And should we get down to this here, there's a possibility for a re-entry to now trade lower. So you just have to know where your external structure and your internal structure is located. But we'll click on it. We'll move this over. We see price ran and hit our level, hit our POI. Even if it was this POI here that we, tailored it to, or the larger POI above. Either way, our stop would not have to be behind here. It could be right at that level there, right? And that's hitting both levels, the level of the internal POI, right, and the level of the larger POI too. So if we click forward, there we are. We hit the TP, right? If we want a runner, we can set the runner, and then the runner for our runner, and then the runner for our runner's mother, whoever it is, we can set it up. But we got to make sure that whenever we are trading, it's no zone, no trade. Now look at what happened if you did not take your profit right here. Look at what happened with the euro. It goes right back to entry, right? But you might think that you can find some sort of re-entry after the high is taken, and then what? Invalidation gets hit after. I mean, that would have been a nice re-entry since this is the daily, but you just don't want to get into the habit of trying to re-enter on those things until you see some clear sign of the market trying to take us lower. It's not showing that it's trying to take us lower because no structural lows have been taken. So we see another high gets put in. Now it's above that invalidation, right? But it's still within the larger one, right? So when we play euro forward, we see that it even respected the larger one, and then went and did what? Traded down to the BE position of the larger euro USD short. So these things are going to be on every single time frame. They're going to be on every single pair. This is just the way the market moves, and you have to just trade in the direction that the market is trading in. And this will teach you how to do that with management. So let's go to oil real quick. And You see us in oil, you see us tap into that previous range and then trade higher, right? To target this impulse, right? Then let it down, right? This is on the hourly, right? So I didn't even bring you here to show you this. I bring you here to show you the other side of the entry. If you look right here, this is a POI that we hit, and we had talked about this in the mentorship, that we were looking for price to tap right into this POI. That's the 50% right there, right? So let's say we tailor our risk to here, and we want to look for the internal. Internal is already 1-to-1. External is here actually. That's 1-to-3, and you keep going. It's insane the potential you can get just by what? Trading in your zone. That's the first thing. So you still got to learn how to choose the right zones, right? And that's stuff that's been taught in the playlist already. So you could learn that for free. FREE, free. But you find your entry, and now here's the way you could manage it without costing your capital, without price coming back to your entry. So there's a ton of things you can do. And here's the last thing on Bitcoin. This is the one that I call on Bitcoin. We were waiting for price to take out this low. We were waiting for us to run below here. And we were expecting price to trade back inside the range, right? So this was more of a larger time frame play. With the outer impulse here, and here's the inner impulse right here, right? And look at where we are with the current inner impulse. What kind of R is that? That's 19R from this low, based on a concept that we already teach here on the channel, right? But now with the management of knowing what's in our higher time frame view. So I hope this video was informative to you guys. I hope it was educational. I hope that it helped with, just some of those poor stop loss placements and management techniques. And I believe that this is it. This is the number one thing that you guys needed to consider your entries, because if you have a great entry, then you could at least manage that position. But if your entry has been underwater the whole time, it's very hard to dig your way back out of trading with certain approaches like that. So happy back testing, and tell me what you guys think in this video below.